Okay, so O's question. Will you use a butterfly for a low-cost hedge to a portfolio? Personally, no. I use VIX calls. That's what we talked about at the very beginning of this presentation. What would have happened had I used the VIX calls on Friday for Jim's question last week? I usually have VIX calls in my portfolio for the unexpected. We talked last week a little bit about the hedge there. Let me just look up VIX real quick. I'll get to this for you. There it is. Is now the right time to buy VIX calls? In this conversation also, I'll mention it here. I'm not diverting your question. But in this case here, what we also talk about is approaches for using other hedges. Okay, and here's one bull put discussion and VIX calls as a hedge. That's from last month. Hey, calendar spreads, diagonal and horizontal, VIX for buying market and flash trades, exactly around 1 year ago as well. So that's a full webinar like this one. But in any case, VIX calls is one way to hedge. Another way to do it, of course, is by buying cheap way, as you mentioned, is buying calls or puts on SPY. And you say, well, aren't they expensive? Well, no. I don't know if you were here with the beginning of the presentation. When I buy VIX calls, I'm looking to buy a call that expires 45 days away. And I'm looking for the out-of-the-money call. So on Friday, it would have been the 18 strike with a premium of about $1. That's pretty inexpensive. Why am I going to concern myself with trying to hedge this cost if I say, oh, well, I could get into something similar if I did a broken wing butterfly or if I did a double back ratio put spread and lower the cost basis down on that and still have some benefit to the downside if it crashes or upside if it moves up. I wouldn't lose much. Why complicate it? Okay. If you want to pay in a low cost, look for the low cost option that's out of the money. It's still a 65% return with the movement today. And that's used as a market hedge. But just trade the number of contracts that aren't as expensive to you. Yes, we would all love a way where we could generate income up front, lower the cost basis, and get income into our portfolio that would hedge us if the market swings wildly one direction or the other. But when you're selling, you don't have that. When you're selling, you're entering into an obligation to do something, deliver something, or be assigned. So it has a capped gain one direction or the other. You don't get that infinite gain in both directions, okay? So to me, the butterfly on SPY or something to hedge my portfolio, I don't do. I don't do really the ratio put back spreads that I mentioned that are somewhat popular. I don't do that. Look, what does these two strategies look like in comparison, okay? So I'll stick with the 45 days out, just as a random gauge. Oh, contra ETFs. Thank you, Sam. Contra ETFs, I don't think I mentioned. You could just buy single shares of a inverse ETF, what's known as a contra ETF, or you could, buy calls actually or puts on that as well, okay? Edison, I can't answer this question directly. You say how much VIX calls to hedge how much investment. That's up to how much you think you need to protect. Okay, but we're going to talk about that a little bit more in a little bit. That's not a question I can answer. I'm not your advisor, and I can't go into that as well. Okay, all right. Okay, oh, I understand. He says, I'm trying to hedge a $300,000 portfolio. I understand. But what I'm saying is that a reverse butterfly is the only thing that would give you the kind of gain you're looking for. Not a true butterfly, because that would lose as it goes up or down. The butterfly is losing as it's moving up or down. You're talking about sort of an inverse butterfly that looks almost like a strangle but still has a capped gain one way or the other. Once you hit that cap, it's not protecting anything anymore. Okay? Butterfly isn't a hedge. Butterfly's income or an inverse butterfly could be used as a hedge. It's not going to be cheap to insure a portfolio. It isn't. There's no magic spread, double spread, six-leg spread, or thing of that nature that's going to allow you to bring in premium or pay a really relative low cost and have the same kind of protection you would of just buying calls on an inverse ETF, buying shares of just an inverse ETF, buying calls on the VIX, or just buying puts on SPY or SPX. Okay? So a standard butterfly position, call or put, broken wing or whatnot, to get into a lower cost, is a neutral position. It doesn't gain as it goes up or down. So, you might sell two here, buy one 3 points away. I'm sorry, I should have done that a different way. But let's just do this opposite broken wing here. That was a bad look there, okay? This is not going to be the structure we were considering. But this is a standard butterfly. Now, sorry, my fault, didn't do that for me. Okay. All right. $211. Perfect, right? There we go. Okay. So this is the type of butterfly we're talking about. It's a lower cost position. And the idea here is if the market falls, so what did I do? I sold 2 at this price, bought one here, a lower strike out of the money, and bought one way far away to keep the cost low. This is only a debit of 236 to enter this position. And we're at 333. You know, Sam was talking about his 341 puts that he bought on Friday. He's probably looking at close to 60 to 70% gain on right now as well. Okay. I'm going to get to that in a moment, Sam. Thank you. All right. So what did this butterfly do for me? Oh, well, what it did is if the market falls, if I had done this, you know, with 341, let's say, in this case, and we did this other extended broken wing butterfly here with the puts, or we could structure it the same way with calls. It looked the same, and it looked like this. Okay, so that was when it was at 341, 340. You know, the other day, Friday, 338. But what happens when it fell down to 333, where we are right now? Did you get any other benefit other than this little hedge of $133? No, that's nothing. That didn't do anything for you. Here's the stock price now. This just did that. You don't get this. You get that maybe 2 or 3% of the time in a standard butterfly strategy. It's solely based on management to roll it, move it, and adjust it one direction or the other. This didn't hedge you much at all, though it's lower cost. But see, once you got past this point, this hook, there's no more protection. You're losing more on the portfolio to gain nothing else at a capped set. It's going to have to be rolled and adjusted. It's not an insurance policy if you have to keep rolling and adjusting it. It's a different strategy. What is the reverse butterfly I was talking about? This is a butterfly, peak profit and loss chart, neutral position. Not really what we look for in a hedge because we want something that gains in one direction or the other. This plateaus. Low cost, but it plateaus and you never see this. I don't think a butterfly structure of this nature is a good way to hedge a portfolio. Now, the inverse is different. The inverse, I'd be buying 2 at the current stock price and selling these outer wings, one in the money, one out of the money. But you have to be worried about that. Just as we talked before, you could be assigned early. Okay? And what does this give us? This isn't the structure I would have used. I should have reversed it. So let's reverse it. I apologize. And you can see why that didn't work. But let's try it with a 336 put. Instead of the 333, sorry. I'm in the wrong expiration. All right, well, I'll just do it real quick. So this inverse butterfly, and it's not going to give me the structure I want, not because of the different expiration dates, but because of, there we go. Sorry, that's not doing what I want. The premium should be there, but it should be giving me something different. Okay, I'm looking for something different here. What I'm looking for, there's a way to construct the butterfly where you create it in this nature. And that's what I thought this profit and loss chart should be drawing for me, not this. This is not quite what I'm looking for. But this inverse butterfly, when you buy 2 here and you sell the outer wings, you create 2 different sort of spread positions. So now, yes, if the market stays the same, it stays where it is, you lose money here on the debit for this position. But if it falls, you've got a hedge. If it moves up, you've got some profit there. But just like the other position, it's capped. Okay, it's sort of like this position because you're 2 spread, so it's capped. So if it really drops down here, just like the standard butterfly, you gain nothing more. Or the broken wing butterfly, you gained nothing more. Yes, yeah, you buy 2 in the middle, but you sell the wings. That's right. I just saw that. I had that wrong. I sold 1 outer, bought the middle, and then sold the 2 outer. Yeah, okay. So you buy 2 in the middle, sell the outside wings. But again, not a great hedge because it caps it. It caps it. So discussion that we've had before, a lower cost potential hedge that complicates it and may need adjustment because you don't want to buy the puts as you mentioned oh, you don't want to do a long straddle or strangle to protect the downside. And an idea is, I'll go back to this date, is using a put ratio back spread potentially, where you buy 2 and sell 1. This isn't going to be a good look here. I can just tell by the prices. All right, now see, if I just did this, it's a bull put credit spread. If I sold the 335 and bought the 333, I'm in a bull put credit spread, which doesn't help me as a hedge because it lose money. If I did it reverse, it's a bear put debit spread, which would be a small debit. So if I sold, I'm sorry, the 333 and bought the 335, I'd be in a bear put debit. And if the stock fell, it would result in a profit. But again, a capped profit. It's not going to hedge if it keeps falling. It only hedges to that certain point, to that certain amount, then it has to be managed. So what some people look at is the ratio put back spread. Call it a back spread, call it a forward spread. It's the ratio put spread. Ugh. Let me just knock the prices. I'm going to do something strange here, folks. It's okay. I'm just going to try to knock the prices down to get a better skew. Okay? This is not realistic, but that's what we want to see. So what this does here is a lot of investors try to get this at a credit. Oh, so what you're trying to do is enter it at a credit. So you end up with a position that sort of goes here, dips down here to the at the money range, and then just continues up in this direction. It's hard to find these, especially on a lower volatility index ETF that you're using for a market hedge. But the idea is if it goes up, I still make a little bit of profit. If it stays in Death Valley, you have a loss, but that's okay because this is maybe a manageable range of your portfolio. But if it goes down as you expect, what do you have here? You have one spread and an extra long put that's lowered by the cost of the structure. Okay? And so if the market tanks as you're expecting, it goes really down, goes down past 330, 329, dropping down to 3,000 again on SPY, this is going to help hedge some of that portfolio at a low cost with the potential for even some gain if the market continues to move up as you want to. That's the benefit of using this structure, the put ratio back spread, as a market hedge on the ETFs and indexes. But if it stays within Death Valley, how much money are you paying? Don't look at the max profit, I'm sorry. How much money are you risking or paying to stay into this position? You got to remember what your rights and obligations are of this short put to this long put. Essentially a bear put debit spread, isn't it? In that scenario. So that's sort of the look of the ratio back spread. And what we might look to do to hedge for a lower cost that gives you better protection. Remember, the butterfly doesn't give you protection. It's a low cost, but even that broken wing we looked at is something like this. And so where's the benefit if the market really drops down here? You've only hedged this. Meanwhile, your portfolio is going into this range. I don't think that's a good hedge, butterfly position. The inverse butterfly that I messed up but would look like this is, as mentioned to us. Now in here, buy the outside wings. I'm sorry. Buy in here, sell the outside wings. Well, again, if the market falls, you get a little bit more hedge this direction, but it's also capped. So if the market continues to fall down to here, your portfolio is down here, but your hedge is just continuing in this range. This put ratio back spread might be a better idea of what you're looking for. And sometimes you may be even able to structure it at a credit that if the market continues to move up opposite your expectations, you've got a lunch. You can pay for lunch on Tuesday. If not and it stays in Death Valley, that's okay because you're still able to manage your positions. And if it continues to fall in this direction, you've got a market hedge in place that you properly want for a lower cost. Okay. Yeah, Sam had talked about gold a moment ago, and we saw it on Monday or Tuesday hit 1,600 for the first time since 2013 as well. Okay, and there's other ways to structure the butterfly. Sam mentions the fly with a straddle inside. That's a little. This is complicated enough, I think, without going into all of that as well. So, those are my thoughts on why I would never use a butterfly to hedge a portfolio. Not even the inverse butterfly to hedge a portfolio. I like using my VIX calls contra ETFs, maybe even just buying shares of contra ETFs, as Sam mentioned, puts directly on the SPY for better protection, or of course this ratio back spread idea as a hedge, not as a permanent strategy. I tested this for 18 months on random stocks that I thought were bearish to neutral to bullish with that structure of this. And of course what I found is only about 5% of the time you end up over here. 70% of the time you end up in here, and only about 10 to 15% of the time you end up here. So long term as a strategy itself to profit long term, I didn't see it as a winner. I was doing better with the other strategies I was doing. On that note, it's important to mention that if you're concerned about your portfolio, we've talked about VIX calls, we've talked about these market hedges. When I talk about the VIX calls that I'm using as a market hedge, I'm referring to the part of my portfolio that is in bull put credit spreads and calendar spreads, poor man's covered calls, leverage positions which can lose 100%, and you can't let that happen. Okay? And the bull put credit spread portion of my portfolio is only 15% of my portfolio. I have it structured so that I get out if the position is at a 50% loss, not the full loss of 100% on the bull put spread, because if that happens, that throws the entire spread position away. It has to be managed and has to be controlled. I can't control some things like February 5th through 9th of 2018. What happened today, for example. So that's why those VIX calls are there. So if something does happen and some of my bull puts hit a 50 or 60% loss, those VIX calls are countering that decline and keeping me, that's what it is. It's really a bull put credit spread and calendar spread hedge for me, not hedging my portfolio. How do I hedge my portfolio? 50% of my portfolio is in the married put positions with the stock plus put that we talked about a little bit earlier, different than the covered call. It's flipped on its side so that on any position, even with a 15 to 20%, 30% drop, I'm guaranteed not to lose more than 5 or 6% on the core portions of my portfolio. I don't need to hedge this. I'm already hedged and protected perfectly. And those other leverage strategies I use with a smaller portion of my portfolio, which are higher return but can result in 50 to 60% losses in an unexpected event, which is why I'm not trading those strategies with 50, 60% of my portfolio. That's where the VIX calls and the other portions come in. If you have stocks that have a gain right now, an unrealized gain in your portfolio of $300,000, even though it's expensive, the best protection you can have is just simply go to our insurance tool. Take DPZ as an example. Let's say I own 100 shares at $300, and that's $30,000, 10% of your total $300,000 portfolio that you mentioned. Oh, I'm not going to worry about expiration. Okay? But this tool shows me, hey, I've got an unrealized 24% gain in the stock. I could buy put options right now for $600 and guarantee a profit of 17.3% without capping the upside. Even if Domino's Pizza dropped to $2 per share for some reason. For years they've been putting LSD in their pizza dough. I don't know, and the stock drops to $2 per share. I'm still guaranteed a profit of 17.3%. It'll fall overnight tomorrow to $2 per share. I'm still making 17.3%. How does that work? Well, it's a married put, but done after the fact, so I have a bulletproof position because I still have 30,685 invested with the 685 cost of the put, but I'm guaranteed to get 360. That's the strike price. It gives me the right to force someone to buy my shares of stock at 360 anytime between now and expiration. I'm guaranteed a profit, 17%. What is that, 65, 70% of the unrealized 24% return I have? And if it keeps going up, I still have unlimited upside profit potential. If that portion, your $300,000 portfolio, if a lot of that is in stocks, this is the best way. And you can say, oh, well, it's expensive. You know what's more expensive? Not insuring it. You know what can be more expensive? Trying to hedge stocks in your portfolio with an elaborate ratio spread on SPY, and then looking back and saying, well, the market tanked, all of my stocks tanked as a whole, but SPY only dropped 5%. The protection of the ratio put spread hasn't kicked in, but my Domino's Pizza is down 15% from where it was. Tesla's down 40% from where it was. It turned. Walmart dropped down 12% from where it was, but SPY only fell 5%. That hedge I used didn't protect me as much as it should have. That has happened. I had a customer do this in both directions. I had a customer just buy puts on SPY a few years back, and he also did a ratio put back spread on SPY. I think he bought puts in SPX and did a ratio put spread in SPY as a market hedge. And he told me he was still losing money. And I said, well, of course you're losing money. I don't know how you're losing money, but those hedges are losing money because the market's going up. This was in 2016. I said, we're going lower left to upper right. Your hedges are losing money. He says, but my portfolio is down 40%. I said, well, okay, what is in your portfolio? 60% of his portfolio was in GM when GM started to decline. SPX was moving up. GM's losing 20, 25%. SPX is going up 2%, 3%, 4%. He needed to buy the insurance directly. And he would have had a locked-in gain of 5% instead of a 35, 40% loss on the GM position by the time he came to us. Okay, that's the benefit of the protection directly on your stock, the married put structure, and then you can still sell premium in light of this. You can still generate income off of this, as we showed earlier, with that bear call spread that would leave the upside open, but get you to fuller, guaranteed bulletproof status. That's how you do it. Go to the insurance tool on PowerOptions, put in your cost basis for your stock, and the your cost basis of the stock. You can look at different expirations. We can go further out in time. If I'm going to hedge out to 119 days, still locking in double-digit percentages. And still the ability to sell income against it. Still ability to leave the upside open on the position without worrying about it, or without worrying about doing some kind of elaborate inverse butterfly position or ratio put back spread on SPY if 3 or 4 of my stocks fall, but SPY stays neutral and the hedge doesn't work for me. That's the best insurance. Is it expensive? Sometimes, yes, it can be. As in Tesla, we saw how expensive those puts were earlier. But what's more expensive? Not having it in place. Okay? All right. Okay, so Sam was commenting how when you look to sell the calls, you need to be in a trend, like gold was going up and nugget, and then only sell calls if he has a lower cost basis. Sam, no, I did have the earnings straddle and DPZ as we discussed. I did not have STMP. It's 56% gain, 57% gain. But remember, with the 57% gain that Shopify Stamps had, then in that case, remember last year it had the opposite. It dropped 60 to 70 points, I think a little bit more. It almost dropped 75% of its value and the earnings in March of last year. So this is just finally getting back to break even in the recovery. Okay. I love pizza too. So fantastic. Okay, so you have 10 stocks like Apple. Oh, great. You said I have 10 stocks like Apple up $30,000. Check this insurance tool. Guarantee you it's going to hedge better than trying to do an elaborate spread or just buying puts on the ETFs. Check out the numbers, see the expenses then of trying to hedge the total portfolio with just doing something of buying puts on SPY, even buying calls on the VIX, which is just for a sudden market timing like today. Doesn't work, and the VIX, the VIX calls don't work if there's just a steady, slow decline over a 2-month period. You're going to be better off in puts in SPY. But think about what the cost would be to buy SPY puts to quote-unquote hedge your position, hedge your portfolio completely out, to keep the exact same portfolio value you have right now if you expected a 10% decline in SPY. I will send you a link to a video. I did a video on this 2 years ago to show the effects of the cost. Think of how much that would cost. Then come here and check out this insurance tool. Look at the price per contract on the gains on your position and how much you're really paying out to guarantee a profit. This isn't just hedging. This is guaranteeing a profit in some cases. And even if it still is a negative locked-in profit or risk of only 5 or 6%, it is 100% insured, so you can't lose more than that 5 or 6%. It's probably likely going to be close to the same cost of buying 3,000 contracts of an out-of-the-money SPY put if, in fact, SPY does drop 10%, because your stocks could fall more than that before the SPY hits that trigger. Okay, and in that case. So check out the numbers. I'll find a link for that video I'm thinking of in that case, and we'll go from there. Okay, Eric, this is getting a little bit complicated, but that's okay. Let's go back to, what was our original example? Was it DPZ? Yeah. Okay, so let me clear that out. Let me put in a cost basis right now of just a small cost base, small gain, and let's put in 365. Okay, so Eric says, what about buying a calendar put spread roughly 2 to 3 weeks out? For example, buy the ATM put 2 to 3 weeks out, sell the near put 2 to 3 strikes OTM. Okay, well, that poses a problem. We were talking earlier, Eric, about the calendar spreads, the poor man's covered call. Yes, you can do the opposite with the puts. Okay, and going with the time frame in that case. In that case, okay. So first, I thought you were talking about this as a hedge. Okay, the calendar put does not work as a hedge for portfolio or for stocks. And I don't think that's what you meant. I think this comment was related to our other discussion on the calendars. But if I did a calendar spread near term, let's say I sold a 365 put and then went further out in time, 35 days, as you mentioned, 2 to 3 weeks out, 4 weeks out. Oh, this direction, and bought maybe a 385, sort of like the poor man's covered call, but reversed. This isn't used as a hedge, and I don't think that's what you meant. Why isn't this potentially used as a hedge? You say, oh, you've got a protective put in place, and you've got this. Well, yeah, if you're using this put to protect the stock or the portfolio, then you've got nothing protecting the naked put here, which could lose more as the stock falls. Okay, so it's either protecting one or the other. That's not an approach to use. It's actually still bullish on the stock and for a portfolio hedge. Now, I think what he's more asking is, I misread that and I do apologize, but it says, what about doing a calendar put roughly 2 to 3 weeks out, buy the ATM put, so we're going to reverse this, 2 to 3 weeks out, selling something near in. It's just like doing it another way. Okay, Eric, other than the difference of math premium, there's no difference in what you're talking about as opposed to doing a calendar put spread that's buying the put 3 months out and selling 1 month out against it. You're just shortening the time. You'd have the same almost expectations with about a third of the return expectations, and that's essentially it. Okay, there's no difference between doing it shorter term. I'll tell you this, it's much harder to profit because you have less right cycles. You only have 2 to 3 right cycles to get the profit that you want. Okay, and although you're trying to increase your annualized gain by selling shorter term against your 2 to 3 week out puts that you bought, so you're selling every 7 days, you only have 3 right cycles to get there, you're also increasing the average cost. It's cheaper to buy 3, 4, 5, 6 months out in time than it is to buy every 21 days. Is it a good structure to use for leverage return? Yeah, but again, it's a lot of time period, very small time period to potentially get a profit. So what are we talking about here again? We're talking about buying a calendar put 2 to 3 weeks out, buy the ATM and sell the near put too. So we'll sell 370 7 days out, buy a 370 put further out. Okay, so what are you going to see? You're going to see the same exact structure that you'd expect. Yeah, and again, I don't use this, would never use this as a hedge in this case. All right, just me. Because why? Because this is a hedge that is a neutral position, still has exactly the same capped gain or potential second loss. So if I'm using this to hedge something and the stock falls, this is actually losing too if it's the wrong structure, if it's the wrong setup. Now, if I bought 2 here several weeks out and just sold the 1 near term, that's just, why not just buy the put? Why complicate it with that extra cost? Just buy the put against the stock position. Or, buy the put instead of trying to buy 2 and sell 1 as some kind of hedge in this direction. I don't see it. To me, it doesn't work. This is stopping the hedge for the security or for the portfolio because it's only protecting one thing, the short put that you sold in that 7-day time period or the longer term portfolio or the stock itself. It can't do both unless you do it as a ratio. And then if you're doing it as a ratio, why convolute it? Just buy the put on the stock itself and you've got the protection that you want. You don't need a complicated, oh, let me sell another premium against it as a naked put, because if it falls, now I'm losing on this one. This hedge is gone. It's wiped out. I'm still losing on the stock or losing on that naked put position. I would just buy one put. I don't need to worry about paying down the cost for it by selling another put, because that cancels what I was attempting to do in that scenario. Okay, that cancels that situation. Now, if you're talking about a big portfolio view, and you're saying in this case, Mike, you're talking about a standard stock. You didn't say this, but, thinking, Mike, you're talking about standard stock. I'm not talking about that. I'm saying take SPY and go ahead and buy your 3-week out. If you expect the market to fall 10, 15% in the next 3 weeks, buy your 200, 300 contracts at the money. Well, again, that's kind of a concept that we usually like to buy in the money or buy out of the money based on the ATM bell curve that we saw before, because the highest time premium is always at the money. Why? I don't want to pay into it, even if I'm planning on selling at the money for the shorter term. I don't want to buy into the higher time premium. And then we go closer in, 7 days away. We sell our 333 put for 221. Did I hedge this cost of 425 by half, it looks like in this case, by selling the nearer term 28th of February against the 13th of March series? And the answer is yes, I did. But as a portfolio hedge, what do I want? I want something that's going to continue to increase profits to the downside as the stock falls, as the market falls. This is losing. It's the wrong structure. Even though you paid for half of it, it's the wrong structure. And if the market did fall, SPY did fall another 10%, falls down to 300, I'm losing $400 or so dollars. Okay, if it go down to 300, I'm losing $400 or so dollars on this spread. Now, okay, max is 205. I'm losing $200 on that spread, and whatever down here, I'm still losing in the market. It's a no-go. It doesn't give me what I want. Now, you could ratio it, but that's going to mean that you're paying that extra cost for an extra put, and you only hedged it a little bit. You hedged one of the puts a little bit by selling the premium. You still have the full cost of the other put. So again, why complicate it? Why not just buy that one put that would give you the increased profit? And yeah, try to lower the cost, Mike. That's why I want to sell. But then you've entered an obligation and it doesn't give you what you want to hedge. Okay? That's what I'm trying to get across, is that these kind of ideas of doing it in this case, once you try to complicate it by selling in these positions, is going to get there as well. Fernando says, why are the ATM delta on LEAPS options always less than 0.5? Well, it's because of the time value on that. Okay, it's because the time on that positions, the time you still have left on the positions. And if you just look at, next time you're doing it, Fernando, just look at an option chain and go further out in time. Okay, so look at the option chain, start where you're talking about, and then look at the at the money strike and just see how the delta starts dropping and dropping and dropping and dropping as you go further out in time. What does part of that do? You've heard me talk about it before, Fernando. The expectation is those options are going to move less than the near-term options. Why? Because of the lag. You've heard me talk about the lag before, that what's the difference between buying a 6-month output or a 2-year output? Well, the 2-year output gives you that lower protection and lower cost per day, or even a 2-year out call. It gives you the lower cost per day, even though it's more cost up front. But if the stock falls 10 or 15%, that 2-year out leap option, call or put, you're going to see a lag in the price change. It's going to move more slowly, where the short-term options are going to be reacting instantly. And the 6-month out options are going to be reacting fairly quickly. But that's why the delta is only 0.45, because there's a lag for those longer-term options. There always is. That's the lag that we talk about. Okay? All right. Now, Sam added an old comment here, I think. Hold on just a second. Yeah, that's that one. Okay, so I was talking about the DPZ there. Sam, a comment mentioned earlier is, with the coronavirus, the markets will be wild up and down in case protection is needed. Absolutely. The protection is needed, and in topped out of market, don't go full and upside. It can hurt you bad. Exactly, yeah. So hitting the peaks and coming off it as well. Okay, O says, what if you sell the $1 above ITM? That doesn't change the structure. It would still be capped. You'd still have a capped calendar put. That doesn't do it. Okay, this won't do it. If I sell a different put, I'm still going to be this, or it might be this, or it might be this. It's not going to change this structure. It's going to be capped or at a loss on this side. It doesn't change the structure, even if you go in the money in that case or out of the money. That's a calendar put. That's the design. It's a neutral position, and if you're using it as a hedge, it's meaning that your best value for this calendar spread, whether you're using a same strike, a true calendar spread, or what's called a horizontal, or you're using a diagonal put spread where you're buying in the money and selling at the money, or you're selling one in the money and you're buying deeper in the money, you're always in this structure that has a cap. It doesn't continue to profit. The only things that continue to profit and give you a hedge as the market falls in this direction is going to be buying a put, a straddle, a strangle. Okay, so let me here are the positions. That gives you continued protection to the downside as the market falls. Buy put by itself. If you already own stock, buying the put on it gives you the married put. So you're hedging the stock individually, best protection. This would be a married put on, say, SPY. I'm sorry, this is a long put on SPY that continues. The direction continues as the market really falls. That sort of ratio put back spread we looked at. A strangle position, buying a call and buying a put at the money, which O is afraid is too expensive. Okay, so he wants to pay for it. This one kind of helped pay for that hedge. This was a direct purchase. But again, when you talk about the calendar spreads, it doesn't give you which one. If I did a ratio in this sense, I bought 2 of these and sold 1, it'd be more of this type of profit and loss chart, similar to this, but we showed the structure of that earlier. But why complicate it? What do you have here? You have a spread, a bull put spread with a long put. Why complicate it? Just buy the long put, either on the stock or on SPY itself. It's as simple as that. And then, of course, the strangle as well. And we talked about that inverse butterfly that I didn't like because it's 2 spreads that does have some hedge to the downside if it continues to fall, but what does that mean? It's capped. And you could do a bear put debit spread, a vertical spread, or a bear call spread that has a capped profit to the downside in case SPY falls, but it's capped. If it falls further than you expect, you're losing more on your portfolio than this hedge is ever going to get you back. You want something with this open leg to the downside, and that's the balance. I understand. It's very expensive. I'm not going to say it's too expensive for you. That'd be an errant comment. It's very expensive. What's more expensive? Being in the wrong structure, thinking you have a proper hedge on the portfolio when you lose on the hedge and you're losing on your portfolio. That's not where we want to go. That's not where we want to go at all, okay? All right, well, ladies and gentlemen, we are 15 minutes past the hour. That's usually the limit that I allow to take in this case. I think we've explained the different hedges that we would use and why we're looking for something that has that continuation to the downside rather than something with a capped gain and getting too complicated with all these different ratio back spreads and things along those lines. The more you complicate it, the more it's probably not going to meet your goals for a hedge position in that situation. All right, where was I? Okay, so let me get back to here. All right, very quickly, Eric, sorry about that. That skipped in at the end. I didn't see it when I was going through the comments. It says, what kind of ratio would you buy then? For example, I have 1K in credit spreads and or long calls. Okay, well, I showed it already, Eric. I'm sorry about that. I showed it already. Keep the same expiration. You can analyze this on your own. You can see if it helps you hedge what you want. Go a few weeks out in time. Don't worry about this selling near term, buying far term. That's not a hedge. That's a strategy to get premium. That's not a market hedge in case of the uncertain. So what you typically will look to do is what's called a ratio back spread. You can look it up online, do a search for it. What you want to do is typically buy 2 contracts at the money usually, and then you want to sell another contract. You can sell it in the money, but remember, if you sell that put in the money, you run the risk of early assignment. It might be better to do it out of the money. You're not going to hedge as much, but you're going to hedge a little bit. Now, see, this is interesting. Let's say I bought the 333 put, and I sell a 332. I'm buying 2 of the 333. Never sell 2. That gives you the opposite. That gives you infinite risk to the downside as a naked put position. Don't do that. We're buying the higher, and I'm sorry, buying 2 higher and selling 1 lower. Now, this isn't the structure that most people would like to do. Okay, so we're going to buy 2 and we're going to sell 1. You're going to kind of see my argument here in a second. In this particular structure, and again, this isn't the way most people do it, but I'm just showing it to you for example. In this particular structure, it does keep going infinite if we want the stock really falls. But notice something interesting here. I'm buying 2 at 428, and I'm getting 397 back as a premium. Well, that makes my cost basis 459, which is what? Higher than just buying 1 put. This isn't the structure you want to use. What investors attempt to do that is risky, and there's no free lunch here, guys. You can get the protection in place. You can get it potentially at a lower cost. But what am I doing? I'm sorry, I'm going to buy 2, 13th of March. That was 21 days out. And we know that's going to be about 840, 850. So how am I going to hedge that? Well, you have to keep the same expiration. So I've got to go to March 13th. And we sell an in-the-money put. I would never do this, but, if I sell it for 872, well, let's just cut it down. Let's sell the 333. I want to keep it even. Okay, let's sell the 337. 580. So this is the structure that you want to look for. Okay? You're going to sell 1. You're selling an in-the-money, buying 2 kind of at the money. And we could sell at the money and buy 2 out of the money. We'll look at that in a minute as well. This is why I'm saying there's no one law, one rule, Eric. It comes down to what you're comfortable with as a hedge. Okay. Should be doing this, I'm sorry, on a different stock position. This is the structure that we'd look for. You're just not seeing it on the scope. So this would be here. If it goes up, it's a loss of 200, and this would continue this way to infinite profit. Okay, you can see that kind of by the curved line there. Max profit at 0 is this. We've lowered the cost down to 271. But we have to keep something in mind. You're selling a 337 and buying a 333, which is what? A bull put credit spread. So you have to cover the 400 points on that bull put credit spread. Yes, you lowered the cost of the put down to 271. So you're buying an at-the-money put for 428. You're buying 2, and you're selling 1 against it to cut down the cost to 271. And you say, okay, well, I've got the insurance in place with an at-the-money put that only cost me 271. But you're going to take a $400 loss on the bull put credit spread if the stock falls. Why not just buy one cheaper out of the money put for 271? The reason people are trying to do this is they're trying to do it in a different fashion if you can get a credit. And it's not easy. A lot of times it's not easy, Eric, to get the net credit in this structure. Okay? And that's the hard part of the strategy. So let's go again. I don't think we're going to find one, but let's go again. 21 days out in time, that 3 weeks we were talking about. And I'm going to sell this. And see, now the spread's getting too wide, but I'm going to buy 2 of these. Okay? So I'm buying 2 deep out of the money in this scenario, Eric, 325 strike. And I'm going to sell 1 slightly out of the money, 333 put. Now, we take in 428 for the premium. We pay 460 here, so I'm only at a cost of 32. So even if the market stays up here, it's a loss. Now, this would start to kick in as it continues to fall, but we're talking about almost a 10% drop. It'd have to be about 300 before we see a profit. The cost is low. Where's the benefit? Most likely, you're going to end up, if there is a decline, in Dead Man's Valley here. That's what we sometimes call it, Death Valley, Dead Man's Valley, where you're actually taking a 400, 500% loss because of the strike difference of this bull put credit spread with the extra long put. Maybe just buy a put for $1. Maybe just buy the 327 put for $3. That's low enough cost. All this little hedging of, okay, I'm only paying 32 cents. I'm paying a tenth the cost, but it entirely changes the structure. It doesn't get you to where you want to be, okay, unless there is a significant drop in that scenario. That's what we're looking at here. So, but that's how you do it, all right? The ratio put spread is you're selling a higher and buying 2 lower, essentially creating a bull put credit spread with an extra put and trying to lower the cost. But then ask yourself when you graph it, does it solve the problem if I'm expecting a 5%, 7%, or 10% decline in SPY or whichever security you're using? On that note, if you try to get it to a credit, and let's say you're selling the 336 and buying two 333s where you've got an in-the-money put, just remember, you can be assigned on that put at any time. And there may not be a guarantee your broker, if it's at 334, what happens? Well, your broker doesn't exercise the long to deliver the short. If I did a 333 combination with a 336 in the money sold, the higher strike sold, and the stock SPY is trading at 334 and someone wants to assign me, I'm now buying X amount of shares of SPY at $336 per share. You could sell to close them in the market, of course, but you're not going to exercise the 333 strikes if the market's offering 334. These puts are still out of the money. The hedge hasn't kicked in yet because it didn't fall as you expected, and you got assigned early. Now you've got to cover that as well, okay? Okay, Eric, I'm going to have to, it's almost 6:30, so I'm going to have to find you the video to that. It's not simple math, but it's pretty easy. You said, sorry, I meant how much should be straight put cost if I'm trying to hedge 1K. It's not the put cost, okay? It's what does the put gain? And that's what you can use this tool to do. You can run the what-if scenario. So if you say I just bought one put on SPY for $2, the kind of cost of the put is not what's important. The number of contracts is a little bit more important, but it's not the cost of the put. It's if you expect SPY to drop 10%, how much would that potential profit? And if you only expect it to drop 5%, you'd probably choose a different strike. That's the key. It's what is your expectation of the decline? Not trying to just say, is there a magic, hey, you always buy 2 strikes out of the money, put in $500 to hedge a $1,000 credit spread. Because if your expectation is going to drop 10%, you actually probably need less of a hedge in that case. You need less contracts. But if you expect only a 4 or 5% decline, you might need to buy a few more contracts to get the hedge for that $1,000. And I know I discussed that in that video. It's from a year or two ago. I just have to go find it, and I break down sort of the math. It's probably on that webinars page somewhere too. But I'm going to find that for you, Eric, and I will send that to you over email. All right, well, ladies and gentlemen, have a fantastic weekend. I don't know what screen I'm on here. I'm on this screen. There you go. Have a fantastic weekend. Thank you for your great questions.